Now, I said that we're going to talk mainly about cash in terms of your small business survival and the ability to run your business on having a spare pot of cash. But I think it's also really important just to cover now profits, because profits are a really important figure in terms of knowing whether or not your business model is sustainable. Now, I often meet business owners who get really confused between the difference between cash and profit. So I'm going to use an illustrated example to try and explain how those two figures are different and what you should be using them for. So let's start with profit. And I'm going to introduce you to my friend, Ali, and she runs a wedding cake business. Now, when you look at trying to calculate her profit, we're going to look at the period between January and March. That's 3 months. And in that time, she invoiced for £1,000 worth of cakes. That's her customers had purchased cakes from her. Now, in order to generate £1,000 worth of cakes, she had to purchase £200 worth of raw materials specifically for those cakes. And then during that 3 months, she paid herself a salary of £50 a month. So that's £150. Her rent and rates worked out to be £25 a month. So that's £75 for the 3 months. And her energy and utilities are £15 a month. So that's £45 during that period of time. So her total costs are £470, as you can see, which shows that actually at £470 cost, she makes a nice healthy profit of £530. So that tells us that Ali's business model is profitable. She gets her selling price is sufficient, more than sufficient, to cover all her costs, and therefore she makes a nice profit of £530. Now let's have a look at this in terms of cash. So here we go. Here's her cash. Her cash actually doesn't come in from her customers until February and March, because she actually doesn't get the cash in until she actually delivers the cakes to the customers. However, she has to spend out some money on raw materials, and there's the £200 going out. And also she pays herself £50 a month. So the first difference is the timing between the cash coming in for what she sold and the cash going out for the raw materials or the ingredients for those cakes. But notice here, there is no timing showed. It's simply matched against the sales invoiced. For her salary, that's very similar, that's £150. But look, here's another difference. Although we've charged in terms of costs, rent and rates at £25 a month, in reality, she has to pay her rent and rates up front for her premises, and that works out at £300 that she has to pay, which is the full year's amount on the 1st of January. The utilities go out as a monthly amount, so that's fine. But here's another difference. Her oven broke down, and in March she had to pay out £600 for a new oven. However, this type of expenditure, which we call capital expenditure, is not shown in our profit and loss, because we only match here in our profit and loss the costs associated with generating that particular £1,000 worth of sales. And we would say the costs of buying a new oven really should be spread over the time we think that oven can be used. So in her case, she believes that a new oven would last her for about 5 years. So really, we should only be matching off a 60th of £600 per month. And that's what we call depreciation. Now, I've not shown it here because she didn't get her new oven until March. So we would just put a 60th in from April onwards. Now, it doesn't show in her profit and loss. she's showing a healthy profit, but cash flow wise, she's actually had quite a lot of cash going out, including that £600. And you can see here, her bank balance is in negative all the way through that period. So there I've demonstrated to you, hopefully, the difference between profit and cash flow. And there's a good example also of a business that is profitable but has negative cash flow.